Hello, it's Pat and Greg again with a quick update on our Vise portfolio's performance through the end of August. Greg?
Yeah. So it's been a strong year for equities and our models have done really well. We're going to go over our Vise portfolio that has 70% in the US, 50% of large cap, 20% small and mid. And then it also has our semis overweight, Blackstone and Welltower. And so year to date, that is up around 13%. And that's before taking into account the benefits of the tax loss harvesting that buys, just add almost another 2%, really because of the tariff tantrum we had earlier in the year. And so that's, really done better than the S&P, which is up, a little over 10, slightly behind the MSCI All Country World, really because thus far, although maybe not after today, Asia has slightly underperformed Europe. But as, we say, we have not been in Europe. We're happy to not be in Europe over the long term. So it's really been a very strong performance with a very diversified portfolio.
What we're trying to achieve in the portfolio is to give you broader diversification and mix together cheap and expensive. And if you look at our allocation, the US allocation is 50% in the S&P, which is really weighted towards 7 names. 35% of the S&P value is the Magnificent Seven. And so we also own small mid-cap stocks. But more importantly, we own non-US. And as you've heard us talk about this before, Japan is the largest weighting at 7.3%, followed by China at 6.1%, followed by India at 3.6%, Canada, Taiwan, Australia. And year to date, China was up huge today. We're in the month of September, so it's not reflected in these numbers. And we have this belief that we think that the United States of America is really going to win the game in software and services with all this new technology. We think financial services is going to go from 20% to 40% of the US equity market because of the crypto, blockchain, fintech, and now we're regulatory environments allowing mergers, and that's really exciting. And we think it's also very possible that Asia is really going to win in advanced manufacturing and is really cheap right now. And if the United States were to fumble, if we were to actually lose the future for whatever reason, we think the people who would beat us would be Asia. And so that's hence the reason we have the bet in the portfolio. Let's take a look at metrics next.
Yeah, so what we have with this portfolio is forward P of just over 20 times. So again, it's somewhere between the really, really rich valuation of the S&P 500, which is very focused on an expensive Mag 7. It's balanced off by the much less expensive portions that are outside the US, and the small and mid-cap stocks as well have lower valuations. The dividend yield is about 1.7%, and so it's providing some yield. We expect that to grow over time.
Yeah, we're very bullish on dividends the next decade. If we see higher profitability, which is our core thesis is the average stock, not the tech names, the average company is going to improve their profit margins markedly through automation from AI and robotics. Perfect example of this, if you watched the news a couple of weeks ago, is Starbucks. They're in the coffee business, is cutting $1 billion out of their costs through inventory savings with AI product. So that's pretty incredible. And so that's how we're allocated. At the US portfolio, it's 51% large cap stocks, 11% mid cap, and 8% small cap. Remember that mid and small cap have really underperformed the last few years. So there's room for catch up here. And I think, Wall Street is always about what's out of favor comes back in favor eventually. Internationally, it's 24% large cap. There you really own the mega cap stocks in Asia. They're mostly tech and the big automobile companies, the big manufacturers of electric cars, and then, of course, banks in Asia as well. And then 4.8% is mid cap and 0.7% small cap. So predominantly large cap.
This is consistent with what we'd want. We want to have small and mid cap exposure in the US, but outside the US, we really want to stick with the leading companies. And that's what we have with this index.
Yeah. And if you look at our largest holdings for most clients are, Blackstone, because it's performed so well and it's an overweight. Welltower performs so well and overweight. And then with semiconductors, NVIDIA, Taiwan, Semiconductor, Microsoft, Apple, HDFC, which is the biggest bank in India, Broadcom, Alphabet, Amazon, Meta, Tencent, and Tesla. So we have, a lot of exposure to these tech names in the portfolio. We've actually tried to mitigate some of that and diversify it through our allocation. We love these names, but as the bull market goes on, there's more risk in stocks that keep outperforming. Our model is continuing to work. You have global diversification. Our thesis on Asia is starting to play out. I feel more strongly about it today. In particular, we think that people are going to have to go into Asia now. Everyone left China, and they're going to have to come back because it's outperforming and people aren't there. And nobody's talking about it. They'll be talking about it by the end of this year because managers are so behind, right?
Yes, no, I mean, I think it's a good summary. We're really pleased with how the portfolio's done, and we're also pleased to continue to own it. We really think it's a broadly diversified way to express our globally bullish opinion. And so thanks for taking the time and allowing us to share with you what we're doing.
And it's really cheap and it's really efficient. And so this is the way of the future, is managing money cheaply, efficiently, in a tax-friendly way. Thank you so much.